$100 billion in AI chip revenue. Not a projection from some blue sky analyst. That's the number Broadcom's own CEO says he has line of sight to by 2027. Let that land for a second.
And what makes that credible is the backlog behind it. $73 billion in committed orders over the next 18 months. This isn't a wish list, Hudson. These are signed deals.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're going deep on Broadcom, ticker AVGO. It's a company most people couldn't describe 5 years ago that's now a $1.5 trillion infrastructure giant sitting at the very center of the AI build-out. Lana, let's unpack this one.
Let's do it. There's a lot of runway to cover here.
So Broadcom was originally founded in 1991 by Henry Samueli and Henry Nicholas, both out of UCLA, as a fabulous semiconductor company. Fast forward through a series of transformative mergers, and today it's headquartered in Palo Alto with about 57,000 employees and a market cap of roughly $1.5 trillion.
The business runs through two segments that are roughly equal in importance. Semiconductor Solutions makes up about 58% of revenue. That's networking switches, wireless components, broadband chips, storage, and increasingly, custom AI accelerators built for hyperscalers. The other 42% is infrastructure software, anchored by the VMware acquisition.
And the VMware piece is huge for the story. Before that deal closed, Broadcom was predominantly a chip company. Now they've got this massive software business, generating sticky recurring revenue from enterprise customers running cloud infrastructure, mainframe operations, and cybersecurity through the old Symantec and CA portfolios.
What makes the current moment so compelling is the AI revenue trajectory. In Q1 of fiscal 2026, Broadcom reported $8.4 billion in AI-related semiconductor revenue. That's up 106% year over year. They're designing custom chips for the biggest AI players on the planet, and the backlog suggests this is accelerating, not plateauing.
And the moat here is genuinely physical. You can't copy a Tomahawk 6 switching chip overnight. It takes years to design and billions in manufacturing. Broadcom's dominance in high-bandwidth networking means every megacluster of 100,000 GPUs needs their silicon to talk to each other. That's what makes this more than just a cyclical semiconductor story. The man steering this ship is Hock Tan, and his story is fascinating. Born in Penang, Malaysia, he came to MIT on scholarship and earned both a bachelor's and master's in mechanical engineering. Then he went to Harvard Business School for his MBA. Before Broadcom, he worked at GM, PepsiCo, and Commodore International before running integrated circuit systems as CEO.
Tan is fundamentally an M&A architect. He built AVGO Technologies through disciplined acquisitions, LSI Brocade, and then engineered the AVGO-Broadcom merger in 2015 that created the modern company. Wall Street trusts him implicitly. Over 90% of analysts have buy ratings on the stock. He's known for picking his spots, executing cleanly, and allocating capital with surgical precision.
He even tried to buy Qualcomm for $117 billion in 2017, blocked by the U.S. government. But that tells you everything about his ambition. At 74 years old, he's running one of the most consequential companies in the semiconductor industry.
All right, let's get into the financials, and there's a lot to like here. Broadcom trades at about $326 per share, with a market cap of $1.49 trillion. Trailing 12-month revenue is $68.3 billion, up over 25% year over year. And this growth is accelerating. Q1 fiscal 2026 came at $19.3 billion, up 29%.
The valuation multiples are where it gets interesting, right? Because the PE is 60 times trailing earnings, which looks steep.
It is steep on a trailing basis, but the forward PE drops to under 27 times, and that tells you everything about the growth trajectory the market is pricing in. The price-to-sales ratio is 23.5 times, which is elevated, but for a company growing revenue at this pace with the backlog they have, the street is willing to pay up.
What about margins?
Gross margins are 67.8%, which is exceptional for a company with a hardware component. Operating margins sit at about 40%, and free cash flow, this is the number that really stands out, $26.9 billion over the trailing 12 months. That's a free cash flow margin north of 40%. Capital expenditures are remarkably low at just $623 million because Broadcom is fabless. TSMC does the manufacturing.
So the cash generation machine is running hot.
It is. Operating cash flow was $27.5 billion. Cash on the balance sheet is $16.2 billion against $65 billion in total debt. That's a legacy of the VMware acquisition. But with the interest coverage ratio at over 9 times and free cash flow this strong, the debt is very manageable. They're paying it down steadily.
And quarterly revenue has been marching upward. $16 billion in Q3 of fiscal 25, $18 billion in Q4, and then $19.3 billion in Q1 of this fiscal year.
Overall, Broadcom's financial health is strong, exceptional revenue growth, best-in-class margins, and a free cash flow engine that generates nearly $27 billion annually. The debt load from VMware is the primary overhang, but it's being serviced comfortably by the cash flows.
Let's talk about what the analyst community is saying, because the conviction here is nearly unanimous.
The consensus is a strong buy with 30 analysts covering the stock. 27 have buy ratings, 3 have hold, and there isn't a single sell. The average price target is $458, which implies about 40% upside from current levels. The range runs from $335 on the low end up to $630 at the top.
Goldman Sachs is at $450, calling Broadcom a long-term AI infrastructure winner with sustained chip supercycle momentum. Morgan Stanley is at $470, focused on the custom AI chip and networking positioning.
JP Morgan went to $500, arguing that the backlog visibility and VMware margin expansion are underappreciated by the market. Benchmark recently raised their target as well, citing AI chip growth acceleration. The most recent earnings report in March beat on both revenue and EPS, $19.3 billion versus the $19.3 consensus, and $205 versus $202 on earnings per share.
And the guidance was the real kicker.
Absolutely. They guided Q2 fiscal 2026 revenue to $22 billion, that's 47% year-over-year growth, with AI semiconductor revenue alone expected at $14.8 billion. For the full fiscal year, they revised upward to $107.7 billion in total revenue with earnings per share of $11.69. Those are staggering numbers.
All right, let's lay out both sides of the argument. The bull case for Broadcom starts with the AI supercycle, and it's hard to overstate how well-positioned they are. They're designing custom chips for Google, Meta, Amazon, and now reportedly OpenAI through Project Titan. When the world's biggest AI companies need custom silicon, they're calling Broadcom. That $73 billion backlog isn't just impressive, it's unprecedented in the semiconductor industry.
And the bear case is equally important to understand. The biggest concern is customer concentration. Over 60% of AI revenue comes from just 5 hyperscaler customers. If any of them pulls back on CapEx or worse, decides to bring chip design fully in-house, that creates a very real revenue cliff. We've seen this movie before with other semiconductor companies that got too dependent on a handful of buyers.
Fair point, but the switching costs are enormous. You don't redesign a custom AI chip in a quarter.
No, but the risk isn't that they switch tomorrow. It's that the next generation of designs might go to a competitor or in-house. There's also the sustainability question around AI spending broadly. If we hit an economic downturn, hyperscaler CapEx budgets get scrutinized first, and the valuation gives you very little margin for error. 60 times trailing earnings means any growth disappointment gets punished severely.
What about the supply chain angle?
TSMC concentration is a real risk. Broadcom has locked capacity through 2028, which is smart, but any geopolitical disruption around Taiwan would be catastrophic for the entire business. It's not unique to Broadcom, but with their premium valuation, the stock would take a disproportionate hit on any Taiwan headlines.
Let's see how Broadcom stacks up against its semiconductor peers. We'll look at Qualcomm, Intel, and Texas Instruments.
Qualcomm trades at about 33 times earnings with a PS of 5.2 and revenue growth around 14%. They're much cheaper on a multiple basis, but they're heavily tied to the mobile market. Broadcom's AI exposure and software diversification command a significant premium.
Intel is the most dramatic contrast. And Texas Instruments.
TXN is more of a defensive analog play at 35 times earnings with about 5% revenue growth. They're a solid, stable business, but Broadcom's 25% growth and AI positioning dwarf the growth trajectory. The valuation gap between the two reflects the market's assessment of AI optionality versus analog stability.
Let's look at how options traders are positioning around the stock.
The put-call ratio is 1.03, which is essentially balanced with a very slight bearish tilt, meaning there's roughly equal bet volume on both sides. Implied volatility sits at the 33rd percentile, which is actually quite low, suggesting the market expects relatively muted price swings in the near term, probably reflecting the post-earnings information dump.
So traders aren't expecting fireworks right now.
Not in the immediate term, no, but the open interest clusters tell a more nuanced story. Call open interest is concentrated at the 350 and 400 strikes, suggesting bullish traders are positioning for a move toward the 52-week high. On the put side, clusters at 300 and 280 indicate downside hedging. It's a market that's positioned for the AI thesis to play out, but keeping insurance in case of a broader pullback.
Insider activity. What are the executives themselves doing with the stock?
There have been no notable insider buys recently, and we've seen about 6 selling transactions in early 2026. The most significant was CEO Hock Tan selling 70,000 shares at about $347 per share, netting around $24 million. That reduced his stake to about 908,000 shares. CFO Kirsten Spears also sold about $10 million worth.
That sounds like a lot of selling.
It's worth putting in context. Total insider sales were around $45 million in early 2026, and the transactions are primarily sell-to-cover for RSU tax obligations. This is standard executive compensation mechanics at a company this size. The CEO still holds over 900,000 shares. That's a substantial position worth north of $290 million. I'd characterize this as routine compensation management, not a signal of lost confidence.
All right, let's flag the key risks investors should be tracking.
4 main ones. First, customer concentration. 5 hyperscalers driving over 60% of AI revenue creates binary risk. Second, AI spending sustainability. If macro conditions deteriorate, hyperscaler CapEx is where the cuts come. Third, TSMC supply chain vulnerability. Lock capacity through 2028 is great, but geopolitical risk around Taiwan remains an existential concern. And fourth, valuation. At 60 times trailing earnings and 23 times sales, any growth deceleration triggers a meaningful multiple compression.
And the key catalysts to watch going forward.
Q2 fiscal 2026 earnings will be the next major checkpoint. The street is expecting $22 billion in revenue. Watch the AI revenue number specifically. If it comes in above $15 billion, the $100 billion 2027 target becomes increasingly credible. Also track VMware margin progression. The software transition is a quieter but equally important driver of long-term value creation.
Let's bring it all together. Broadcom is a company that has positioned itself at the absolute center of the AI infrastructure build-out. 25% revenue growth, 68% gross margins, $27 billion in free cash flow, and a backlog that gives them more forward visibility than almost any semiconductor company in history.
The financial health is strong. The growth catalysts are real and measurable. But the valuation demands flawless execution. And the customer concentration in 5 hyperscalers is a structural risk that investors need to size into their positions. The key metric to watch is AI semiconductor revenue in Q2. That's the number that either validates or challenges the $100 billion 2027 target.
Love this one. Broadcom CEO Hock Tan once said, "We don't try to do everything. We pick our spots, we execute, and we deliver." And honestly, that sums up the Broadcom playbook better than any analyst report could. Pick the right markets, execute with discipline, and let the results speak.
It's the antithesis of the Silicon Valley moonshot mentality, and in this case, the results really are speaking.
That's going to do it for episode 56 of Charged Alpha, our deep dive into Broadcom. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.